In minute 50-63 treacherous empire in a single week, not with bombs, not with soldiers, with a phone call and the threat of selling sterling, Britain and France had invaded Egypt to retake the Suez Canal. Eisenhower was furious. He hadn't been consulted and he wanted them out, so the United States Treasury threatened to dump its sterling reserves onto the open market. The pound would collapse. Britain's already fragile post-war finances would be devastated. The choice was withdrawal or financial ruin. Britain withdrew within days. The empire that had spanned a quarter of the world's surface was humiliated into retreat by financial leverage, not military force. Financial leverage for 70 years, no country has had the financial leverage to do to America what America did to Britain that week. No country has held enough US Treasury bonds to credibly threaten a sale that would spike yields, crash the dollar, and force Washington's hand on any issue of genuine strategic importance. Until now, China currently holds over $700 billion in US Treasury bonds. It has been selling them gradually, systematically, and the pace this week appears to be accelerating. This is the story of the weapon America invented and the country that may be learning to use it back. The story of Treasury bonds as geopolitical leverage begins not with China but with the architecture of the Bretton Woods system examined in detail in the second video of this series. When the dollar became the world's reserve currency in 1944, the mechanism that made that status operational was straightforward. Every country that wanted to hold reserves, every central bank that needed a safe, liquid asset to back its own currency and manage its balance of payments needed dollars. And the safest, most liquid dollar-denominated asset was the US Treasury bond. This created a structural demand for US government debt that had no precedent in monetary history. Britain, as the previous reserve currency issuer, had foreign creditors, countries that held sterling because trade required it. But those creditors held sterling cash and sterling-denominated trade bills, not large formal holdings of British government debt. The dollar system created something new, a world in which foreign central banks held hundreds of billions of dollars in American government bonds as a matter of routine reserve management. By the 1915s, the United States held significant quantities of sterling as part of its own foreign exchange reserves, acquired through wartime financial arrangements and the post-war dollar loans to Britain. These holdings gave Washington a specific novel form of leverage over London that had never previously existed between major powers, the ability to crush a rival's currency simply by selling its bonds. Eisenhower's Treasury Secretary George Humphrey made the threat explicit during the Suez Crisis. If Britain did not withdraw, the United States would sell its sterling holdings, the pound would collapse, and Britain would face a financial catastrophe it could not survive without American assistance that would not be forthcoming. The British government, already operating with dangerously thin currency reserves and dependent on IMF financing to maintain the pound's value, capitulated within days. Prime Minister Anthony Eden, humiliated, resigned within weeks. Britain's pretensions to independent great power action died at Suez, killed not by a battlefield defeat but by financial leverage. The lesson was absorbed by every government in the world. Whoever holds your debt holds a weapon. And the United States, as the issuer of the reserve currency that every country needed to hold, had ensured that its debt was held by everyone, which meant everyone was, to varying degrees, financially leveraged into American policy preferences. China's accumulation of US Treasury bonds was not a sudden strategic decision. It was the gradual, structural consequence of China's extraordinary economic rise and its integration into the dollar-based global trading system. Beginning in the early 1990s and accelerating dramatically after China's accession to the World Trade Organization in 2001, China's export-driven growth model generated enormous current account surpluses. It sold far more to the world than it bought, accumulating the difference as foreign exchange reserves. Those reserves, by the conventions of the dollar-based monetary system, were held primarily in dollar-denominated assets, and the most liquid, safest dollar-denominated asset was US Treasury bonds. By 2013, China had accumulated over $1.3 trillion in US Treasury holdings, making it the largest foreign holder of American government debt, surpassing Japan, At its peak, China held over 13% of all U.S. Treasury debt held by the public. This accumulation was, from Washington's perspective, an arrangement of mutual convenience. China's Treasury purchases kept U.S. interest rates lower than they would otherwise have been, subsidizing American consumer borrowing, American government deficit financing, and the overall cost of the dollar's reserve currency infrastructure. American consumers bought Chinese goods. China recycled the proceeds into American bonds. The arrangement sustained both China's growth model and America's consumption model simultaneously. But the arrangement created something that Washington's strategic planners eventually began to acknowledge with increasing discomfort. It had handed China a version of the same financial weapon that America had used against Britain at Suez. Not identical, the structural details differed significantly, but analogous in its essential logic. China had accumulated enough U.S. Treasury holdings that a rapid large-scale sale could meaningfully pressure the Treasury market, spike yields, and create the kind of financial stress that would complicate American foreign policy at a moment of Chinese choosing. This was what analysts began calling, by the mid-2000s, China's nuclear option. Not nuclear in the military sense, but nuclear in the doctrine of mutually assured destruction, a weapon so destructive to both parties that its use seemed irrational, but whose existence nonetheless constrained the behavior of both sides. For 2 decades, the mutual deterrence logic held. China held its treasuries. The weapon sat in the arsenal unused because the cost of using it was prohibitive. The logic was straightforward. If China sold its treasury holdings, rapidly dumped $700 billion or $1 trillion in US government bonds onto the market, several things would happen simultaneously. US Treasury yields would spike as the supply of bonds dramatically exceeded demand. The dollar would likely weaken, at least in the short term, as the massive capital flow out of treasuries moved into other assets. US borrowing costs would rise, straining the fiscal position documented throughout this series. But China would also suffer. Its remaining treasury holdings would fall in value as yields rose. The dollar's weakening would make China's remaining dollar assets worth less in yuan terms. Chinese exporters whose products are priced in dollars would face reduced competitiveness as a stronger yuan. The likely consequence of massive dollar selling made their goods more expensive, and the signal that China had weaponized its financial relationship with the United States would trigger a response from Washington that could include trade restrictions, financial sanctions, or other measures more damaging to China than the treasury sales themselves. This was the mutually assured destruction calculus. Both sides understood it, both sides were constrained by it. What has changed, what has shifted the calculus in the current period is a combination of factors that this series has documented across its previous 11 videos. The first factor is the Russian sanctions precedent. As examined in the fifth video, Washington's 2020 decision to freeze Russian central bank reserves demonstrated that the United States was willing to weaponize its financial infrastructure against a major power in a way that crossed previously understood lines. From Beijing's perspective, this demonstrated that the mutual deterrence calculus was no longer symmetrical. The United States had shown it would use financial weapons preemptively without the constraint of retaliation risk that had previously governed both sides. The second factor is China's own financial preparation. Over the past decade, China has been systematically reducing its vulnerability to the financial consequences of a treasury dump, diversifying its reserves into gold, into yuan-denominated assets, into bilateral currency arrangements that reduce its dependence on dollar infrastructure. The infrastructure that makes a treasury sale devastating to the seller, the lack of alternative reserve assets, the dependence on dollar-denominated trade settlement has been progressively reduced. The third factor is the current geopolitical context. The Iran conflict, the BRICS expansion, the trade war escalation, and the broader contest over Taiwan's future have created a strategic environment in which China's calculus about financial weapons has shifted. The question is no longer why would we ever use this, but under what circumstances would the benefits of using it outweigh the costs. And that threshold has been lowered by every escalation in the broader US-China strategic competition. China's treasury holdings have been declining since their 2013 peak of over $1.5 trillion. By early 2026, those holdings had fallen to approximately $700 billion, roughly half the peak level sold off over 13 years. This is not a rapid dump. It is a slow, systematic reduction that has been ongoing for over a decade, largely below the threshold of major market impact. China has been selling treasuries gradually enough that the market has been able to absorb the supply without dramatic yield spikes attributable specifically to Chinese selling. But the pace matters, and the pace has been changing. The data from the past several months shows an acceleration in the rate of Chinese treasury sales, not yet at the level that constitutes a full weaponization of the holdings, but at the level that is visible in auction demand data and in the behavior of treasury yields at the long end of the curve. This acceleration is occurring simultaneously with several other developments that are directly relevant. The BRICS expansion that added Saudi Arabia and other Gulf states, the acceleration of yuan oil settlement arrangements, and the broader institutional construction of alternative payment infrastructure documented in the fifth video of this series. The combination suggests that China's gradual treasury reduction is not merely portfolio management. It is the incremental repositioning of a country that is reducing its exposure to a financial weapon that could be turned against it, and simultaneously reducing the cost it would pay if it chose to use its own remaining holdings as leverage. Understanding why China's treasury sales matter requires understanding the specific mechanism by which large-scale selling affects U.S. financial conditions. The U.S. Treasury market is the largest and most liquid bond market in the world. On any given day, hundreds of billions of dollars in Treasury securities change hands. The market can absorb significant selling without dramatic price movements. This is the depth and liquidity that makes Treasuries the world's reserve asset. But this liquidity has limits. When selling pressure significantly exceeds the normal absorption capacity of the market, when a large holder decides to sell faster than the market's normal clearing mechanism can handle, yields rise sometimes sharply as buyers demand higher compensation to absorb the supply. This is the mechanism that produced the Treasury market volatility of 2023, when the Federal Reserve's on-balance sheet reduction added supply pressure on top of already elevated yields. China's holdings at $700 billion represent approximately 3% of outstanding Treasury debt. A rapid sale of even half that amount, $350 billion, over a short period would represent supply pressure of an order that the Treasury market would struggle to absorb without significant yield increases. The specific consequence that matters most for the themes of this series is the impact on the U.S. government's borrowing costs. As documented in the first video, the U.S. government is already paying over $1 trillion annually in interest on its existing debt. A significant spike in Treasury yields, say 50 to 100 basis points across the long end of the curve, would add hundreds of billions of dollars in additional annual interest costs, worsening the fiscal trajectory that is already the primary structural stress point in the American financial system. This is why China's nuclear option, even if never fully deployed, constrains American policy. Washington cannot simply ignore the risk of Chinese treasury sales the way it could ignore other forms of Chinese pressure. The financial mechanism is too direct, too immediate, and too consequential. The Suez Crisis parallel that opened this video deserves careful examination because it is both genuinely instructive and importantly limited. The instructive elements: the Suez Crisis demonstrated that financial leverage, credibly threatened, can force policy reversals that military force could not achieve. Britain at Suez was a nuclear power with a significant conventional military capability. France was equally capable. Neither of those military assets was relevant to the financial constraint that Eisenhower applied. The lesson is that in a world where financial systems are deeply integrated, financial leverage can override military advantage in specific strategic contexts. The important limitations. The Suez situation was asymmetric in a way. The current US-China situation is not. The United States and China's treasury sales do not occur in isolation. They are one element of a broader, coordinated repositioning that this series has been documenting since its fifth video on sanctions and the dollarization. The BRICS expansion, which added Saudi Arabia, the UAE, and other major commodity producers to the grouping has created the institutional framework for a coordinated reduction in dollar dependence that extends far beyond China's individual holdings. If the Gulf states that have historically recycled their oil revenues into US treasuries, the petrodollar recycling mechanism documented in the third video of this series begin reducing those purchases at the same time that China is reducing its holdings, the combined effect on treasury demand is significantly larger than either actor's individual action. The yuan oil settlement arrangements that have been gradually expanding since 2022 reduce the structural dollar demand that comes from trade settlement. If oil is settled in yuan rather than dollars, the oil importing country needs yuan rather than dollars, reducing one of the primary drivers of global dollar accumulation. The gold buying documented in this series reduces the share of reserves held in dollar-denominated assets even without direct treasury sales. Each of these developments individually is manageable. Together, they represent a systematic reduction in the structural demand for U.S. Treasury bonds from the foreign official sector, the central banks, sovereign wealth funds, and government-linked institutions that have historically been the most stable, least price-sensitive buyers of American government debt. As this structural demand declines, the marginal buyer of U.S. Treasuries becomes more price-sensitive, more likely to demand higher yields as compensation for the supply that foreign officials. America used sterling leverage to end the British Empire's pretensions to independent great power status in 1956. The weapon worked perfectly. Britain withdrew, humiliated. The empire never recovered its momentum. For 70 years, no country had the financial position to attempt the reverse, to hold enough American debt to make the threat credible, to have built enough alternative infrastructure to absorb the cost of using it. China now has that position, whether it chooses to use it gradually through continued systematic sales or rapidly through a crisis-triggered dump is one of the defining financial questions of the next decade. The Suez Crisis took 1 week to change the trajectory of British imperial history. The equivalent event in the American financial story may take years, or decades, or may never arrive in the same concentrated form. The historical record is clear that the structural conditions for such an event are present in a way they have not been before. The next video will examine something this series has not yet directly confronted: what a world that has moved beyond dollar dominance actually looks like, drawing on historical precedents for what comes after reserve currency transitions, and what the countries that successfully navigated the transition to the new order did to position themselves for the century that followed. Subscribe, because the history is happening now.